Looking back at the performance of global equity markets over the last 12 to 18 months, there is a clear and consistent pattern, namely the poor performance of emerging market equity. Investor sentiment is deeply negative, there are substantial outflows from funds, and now equity markets from emerging economies trade at a discount to developed equity markets. Is it time to have a second look? Shall we go against the flow and buy long-term growth at a discount? Let's first examine why we had such a weakness. We identify three main reasons. First, disappointing economic growth. Second, poor corporate profitability. And third, the Damocles sword of the Fed, which might tighten monetary policy. First, economic growth. Over the last 18 months, there is no doubt that growth in key emerging market economies such as China, Russia, Brazil, Mexico, Turkey, or Indonesia has slowed down significantly. Why? There is a kind of limit toward consumer demand financed via borrowings. And because central banks had to increase interest rates to fight inflation, there is poor prospects for consumer demand over the next few quarters. Even though we expect good exports to recovering economies in industrial countries, we do not believe we are yet at the bottom in terms of economic momentum. Second, emerging market companies, contrary to their counterpart in developed equity markets, have been subject to lowering profitability, leading to negative earnings revisions. Why is that so? They suffer from lower commodity prices, but also from state interventionism, often to the detriment of shareholders. With the exception of China, where there is a clear desire to improve policy, we don't see yet a willingness to reform the economic framework to the benefit of shareholders. Third, there is no doubt that emerging economies have hugely benefited from the Fed's generous monetary policy. Logically, as the Fed is removing such accommodation, we will see increasing stress in weak emerging economies, and it is very important that such economies address this with a proper reform agenda. Interestingly, 2014 is an election year across key emerging markets. All in all, emerging markets are in a much better shape than in 1998 at the time of the Asian crisis, thanks to flexible exchange rates, higher foreign exchange reserves, and much improved public finance. However, complacency has started to emerge, especially if you look at the deterioration of current account balances and rising domestic inflation. As a consequence, even though valuations are much better, we believe there are still some vulnerabilities. As a consequence, we stick to our neutral position versus emerging market equities. Now, let's move to global markets and the position in our portfolios. As mentioned last month, we have used market weakness to selectively add to our equity exposure at the beginning of February. And now we run a slight overweight position toward developed equity markets. Generally speaking, still accommodative monetary policies, robust corporate profitability, and an economic recovery still point to reasonably favorable prospects for developed equity markets.